Thanks so much for tuning to Talking Point. I'm your host, Neeraj Shah, and our conversation today centers around the last couple of days of a scare, if you will, that came into the mid caps and small caps. One may, or the experienced hand may argue that it was not even a meaningful correction in the first place, but a scare it was maybe, and it'll be pertinent to get in the views of two guests. Of mine who are joining us right now on the show, Gautam Duggad as well as Ajay Srivastava. And gentlemen, both of you, thanks so much for joining in. As we speak, Ajay is joining in. I'll just give him a moment to settle in. Gautam, can I start off the conversation with you? What did you make of the last couple of days? I mean, most people want to attribute it to a BSE circular that came in. I thought if circulars can actually move the market so much, then we're still kind of not a very developed market in the first place.
Yeah, Neeraj, you put it quite rightly. Good morning to you and viewers. I think this is not even a blip on the radar. See, you've gone non-stop from March 20, one-way ride we have seen, especially in mid caps and small caps. Clearly, markets are overheated to an extent because we've not had any, even a small correction so far in the last 12 or 15 months. And some of the pockets of mid caps and small caps valuation obviously had got overextended. So it's quite natural that markets will use any excuse, any event, news flow as a excuse for correction. And it's not even a correction, I would say. You look at the S&P BSE small cap index, it was at 27,000 at the peak. Right now we're at 26,000. So hardly 3-4% correction in the index. I don't even call that as a correction. I mean, there has been news flow which induced a little bit of elevated volatility in the whole scheme of things, and that's quite natural for equity markets because you had an extended run of one-way up move, and if markets want to catch a breath or take a breather, that's fine. I mean, it should not cause any sort of concern unless you're seeing some business momentum getting disrupted or fundamentals getting impacted. I don't think such sort of correction should invite too much of a concern.
Okay, Ajay, if you can hear me, good morning. Thanks for joining in. Lovely jacket as always, Ajay. Tell me, your views are usually contrarian. What do you make? I mean, of this corrective move? Start of something, just an event-led thing which the markets misread, or something else? Because everybody in the mid cap and the small cap space were, running around like a cat on a tin roof, so to say.
See, the fact remains, Neeraj, that nobody is convinced about the valuation metrics of most of these companies. And a lot of these companies which are only on BSE are certainly the quality which not a normal investor chases. So let's be honest about it. That's a very small segment of market which deals with these companies which are not listed on the NSE. Number two is, right now the story of the market is momentum. It's not valuation. It's not fundamental. So in a momentum scenario, if you see any roadblock, and a market of mid-cap which is riddled with leverage at this point of time. And that's the common theme across everywhere. And you saw what happened to the two IPOs. So it started with the wobble on the IPOs. There was a shakeout in terms of the leverage positions in the market. Brokers became more saying the financials became a little more concerned. And it flowed on to this BSE circular, which actually had meant for companies not in the NSE at all. So it shouldn't matter. What mattered was leverage was being withdrawn from the market, so people had to sell something. And what do they sell? The worst of the lot, which they're not convinced about it. So the story, really speaking, is it's a momentum investing. I don't think anybody can argue that 90% of mid-caps are overpriced on any parameter whatsoever. But momentum can carry it through. That's a different matter. So it's a more skittish on valuation, leverage moved out, and the wobble on the IPOs. And if you remember, history would turn you right that the problem which started the Reliance Power IPO long back, what boggled the market for at least 3 years after that. I hope it doesn't happen again. But the greed in the IPO market tells us, including the present issue open, which closed yesterday, that sooner or later, this greed is going to overcome this market.
Yeah, well, so many people cited the Zomato example and carried it back to Reliance Power. And when the grey market premium started cracking, everybody said, see, we told you, this will be like 2008. Ajay, just a quick follow-up, really. So one can argue that some of the mid-caps have froth within them. But surely there are, my question really from an investor's perspective, let's assume that the scare is for now behind us, at least momentarily behind us, because there's a bit of stability. at least since in the second half of trade yesterday and today, early morning as well, as far as I remember, at least 20 minutes ago when the markets opened. My question is, if one looks at the corporate commentary, largely pending a third wave not coming in, most people believe that business resumption might augur well for the next 2 or 3 quarters. Valuations, headline numbers, expensive, bottom up, mid caps, small caps, lots of businesses trying to do well. You skeptical about the broader end of the spectrum, or do you believe bottom up stock picking, cherry picking will continue to do well?
Well, one of the conundrum in the market is how do you define a mid cap? Because the NSE, the SEBI definition, of course, has a very large mid caps. Mid caps are really large caps in Indian context. So, one would say that if one were to look at mid caps in the region of maybe 500 to 2,000 crore turnover, if that's the mid cap stories, then you got serious pockets of them which have got great value in them, which are building up good stories. Except the problem coming everywhere is, seemingly, looks to be that the market peaked out in or these companies peaked out in profitability on the March 31st quarter. Now, for them to exceed that quarter, I think is becoming a challenge at this point of time. This quarter, nobody expected anything to happen, so it's gone. Next quarter, the challenge is, will they meet up the March 31st numbers? And that is where the issue is coming up, that you already priced it on March 31st numbers. Now we need to see some growth coming in. And economy growth is not going to be more than 5-6% or maybe 7% at best. And if the biggest vehicle automobile segment does not move, then the segment has a problem, industry has a problem at this point of time. So I think the challenge will remain that you've got to be in segments, whether it is hospitals will do well, pharma, which has had a sell down, continue to do well. Auto ancillaries, depending upon what happens to the chip market, etc., might do well. But broadly, the theme is you got to look at March 31st numbers as the base and say which company can grow. And if you are invested, hold it till the end of this next quarter, because there is no trigger from now till September 30th. Really, the trigger is going to come when the September 30th results come out. And a lot of the specialty companies, chemical companies, they are wobbling because they are facing a tremendous amount of competition from imports. You saw the import tariff barrier came in yesterday on on 2 other companies got benefited out of that. So specialty companies, which are an outrageous valuation, they've never seen this. Ask the promoter, they're saying, oh, are we producing gold? We always produce this product, right? But we look at the valuation. So I think, but whatever you do, the question is, whatever you keep invested in, keep it till September 30th and the results, because nothing much will happen from now to then. Carry your conviction through. Don't speculate on it.
Okay. Gautam, can I get you in? And you said that, you mentioned this point about how the tremendous rally that we've seen, maybe some of the newbies or newer investors, and it's a large portion of our market now, got kind of shaken up with a small correction, but some of these stocks are strong. I counter that point only with one thing, and which is taking a leaf out of what Ajay said. One, the kind of greed, if you will, or the kind of behavior that the IPOs throw up, right? It's telltale signs that retail, classic markers that the retail participation really shoots up. Last month, as I saw, the small cap mutual fund sale was the highest in a really long time, right? That's a classic marker of sorts. And 3, it's not just the valuations at which the IPOs are coming. A bunch of these IPOs are not using the money for, and forget the tech guys, they are actually maybe using the money for the company. A bunch of other IPOs are actually not using the money for the company growth. It's some PE investor, in some cases, so many cases, the promoter himself or herself getting out. What does that tell you about classic markers which typically define when the turning points happen?
Yeah, I concur with that. You look at any parameter, the valuation, the euphoria around in the primary market, the commentaries, the actions of retail investors, and people who have entered the market post March 20. We've seen a lot of news reports about the number of demat accounts getting opened on a monthly basis. That new investor bunch, they've not seen any correction yet, and that's why the reaction will always be very different when we see a slightly extended period of drawdown. I'm not predicting one, but I'm saying if it were to happen, the reaction of this bunch of investors will be very different. Now, we put out a note around a month or so back. We tried to look at the relative context on valuations across cycles in the last 20 years. So Neeraj, this is the first time where your mid cap and small cap indices have had an extended run of 14 or 13 consecutive months of positive returns. And for mid cap, this is a new record. Small cap, it is the second highest because the record still belongs to 2003 period. I don't know if it has been breached in August and September now. So that is point number one. Point number two is that when you look at the relative rolling out performance of mid cap versus Nifty on a 12-month basis, it is at 35-36%, and for small cap it is about 60%. Historically, we have seen this kind of rolling out performance just once or twice, and that too, it was in a very unusual period when you had a bounce after the global financial crisis. Otherwise, typically, last 15 years, if you see, 35% is the outperformance max that we have seen on a rolling 12-month basis. Maybe this is a different time, and there's nothing written in the record that it has to be adhered to, but I'm just drawing your attention to some of the historical parameters. Third, on the valuation front, and looking at mid cap and small cap, index valuation makes not much sense because index has a lot of loss-making companies, specifically in the small cap index. So what you do is typically you remove those 12 or 13 loss-making companies from the small cap 100 index and look at the valuation of rest of the 87 companies and look at it on a trailing basis, right? Because not all companies are well covered in the market in the small cap index. When you look at it on a trailing 12-month basis for the profitable companies in the NSE small cap index, you will find that they are at a very marginal discount now to Nifty. If you are looking at it on a forward basis and all 100 companies, then obviously they are trading at a premium, but that's not the right way of looking at it in my view. So the relative comfort on valuation is clearly missing in both the mid cap and small cap indices. And last point on valuation again, if you go back to our conversation 2-3 years back, we used to discuss polarization in Nifty on performance as well as valuation. It was top 15 Nifty. If you make an index, it used to be at 15,000 when Nifty was at 10,000, and the rest 35 was at 7,000. Something similar you are seeing in the NSE mid cap and NSE small cap also now. If you draw or you make up quintiles of companies in those index, divided into 5 quintiles of 20 stocks each, the gap or the spread on valuation between the most expensive 20 and the least expensive 20 has expanded in the last 8 or 9 months. This is something we have seen in Nifty in 2017, 18, and 19, and now it is repeating in mid cap and small cap index. So clearly, whichever way you cut or slice it, valuations are not looking very lucrative for you. Having said that, there are several companies in the same indices where earnings have been very strong, and therefore people who are looking at earnings 2 years hence, 3 years hence, and are not seeing any concern on earnings story, they will be reluctant to sell, and rightly so, because we have seen that in India, especially in Nifty, we have seen that valuations alone has never worked in deciding your sell calls, right? Asian Paint was expensive at 1,000 rupees, it became more expensive at 2,000. Today it is even more expensive at 3,000. So wherever the earnings story is panning out well, wherever we are seeing balance sheet cash flow improvement, and I must repeat that in FY21, while everyone got lost talking about earnings growth because the earnings growth in FY21 was the best in a decade, the real story was happening in balance sheet and cash flow. You've seen massive deleveraging in commodities, metal, cement. You've seen huge free cash flow improvement in those sectors. And that supported your valuations at the margin in sectors which hitherto has not participated in the market. So, in mid cap and small cap, it boils down to bottoms up stories. There's no point belaboring too much on index, but it gives you a context in terms of where you are in the cycle.
No, and important points, all of those, Gautam. So thanks for that. Ajay, coming on that, so you cite the kind of valuation, quote unquote, froth, for example, in certain specialty chemical companies and certain manufacturing-led indices as well, even though we think that there's a manufacturing renaissance upcoming in India. What does an investor do if let's say, I don't want to get into names, but 2 or 3 recent chemical company IPOs came in at whatever, 70, 80, 90 PE, etc. People bought in and people still made money. The stocks listed at maybe 50, 60, 70, 80% premiums to the IPO pricing as well. My question to you is, what should an investor do? Because if parked in some of those niche mid caps where valuations are high, but the management commentary, the social media awareness about some of these names and the so-called experts on social media putting out why these companies are justified trading at the valuations they are, and forget chemicals, it could be happening everywhere. So should people stay parked there? Should people rotate? Should people sit on cash?
See, Neeraj, first of all, I think the clue is going to be from outside this country that till the Nasdaq, S&P, and Dow remain at historic highs and keep making highs, I think that's the one clue which you have to look at where you are invested and what you want to do with your portfolio. Because if the US story keeps panning out, then the global equity story will remain robust and strong. We won't be an outlier that US will go down drastically and we will go up. That's not going to happen, right? So the clue is coming from the US and saying that if they pass that, the enormously, I would say, lucrative infrastructure bill for most companies in the world, right? Then you are on a safe path because the kind of spending which is contemplated there just takes care of little rest of the world. The rest of the world is not going to spend the kind of money America is planning to spend under the $3.5 trillion kind of infrastructure bill. So the real answer is that you need to take the cue that if the market in US remains strong, then you are in good company, because at the end of the day, it's not fundamental which count of the company. It's your ability to get out of a stock when you want to get out. And it could be for reasons of fundamental. It could be reasons of requirement of money as well. Your child could be going abroad and you want to sell some of the shares. So the key is in mid-cap stock is liquidity more than the valuation. If you ever feel that liquidity is drying up, and you saw what happened in the last 48 hours, it was mayhem because there was no liquidity in the market at this point of time for these stocks. Therefore, you need to be careful that if you have a requirement of funds coming up, which is going to be next 3 to 6 months, then that's a different view. As if you have a requirement that I'm going to keep it for 3 years, that's a very different view altogether. But the fact remains that all these companies run against capacity constraint at this point of time. Specialty and chemical companies certainly do, because you can't produce more than what your plant is capable of doing it. And the new plant takes 18 to 24 months to kick in at this point of time. So therefore, the next trigger is CWIP. Is the company growing? Have they put up a new plant? Or is they going to start the work now? Which means for 3 years, the earning commentary is going to be pretty static at this point of time. There is no magic to produce a number in a chemical company, unlike a consumer company or a liquor company where you can bottle much more in a very short frame of time. But you can't do that in most industrial companies which need capacity at the end of the day. So the story is, look at CWIP. If CWIP is strong, you got to be invested there. Sorry. If CWIP is lacking, then I think your story is picked out.
Okay. Last question to both you gentlemen. Gautam, first to you, and then I'll wrap it up with Ajay. Gautam, where do you guys, as we come to the end of this earnings season, you would have heard most commentaries. I know you look at your coverage universe, but if we exclude the larger boys and focus on the mid-size and the small-size boys that you might have within your coverage, what do you make of the commentary? Where is it that you guys are finding favor within the broader end of the spectrum?
So, Neeraj, the earnings season has been pretty good, actually.
We're talking strictly about mid caps and small caps, yeah, Gautam, not the large.
Yeah. Even if you look at mid caps and small caps and look at the earnings cumulatively, they've met the elevated expectations on a low base, right? There have been marginal cuts here and there. That's the part and parcel of every earnings season. But by and large, the earnings season has passed quite peacefully, and hopes about a very strong 2H FY22 are building up. You look at the commentaries of cement companies, consumer discretionary companies. I'm not mentioning IT because IT is all about large cap. 90% of the profit pool is contributed by the top 5 IT companies. They are in a different sort of a momentum thanks to COVID. They've been the biggest beneficiary of COVID. The commentary around cloud, automation and digital transformation. I think this will last for next 3-4 years easily. This is not a 6 months, 12 month story. And if you look at the mid-cap commentaries also in IT, it's been very, very solid on order book, on offshoring. The sheer fact that there is a war going on out there for talent tells you the extent of demand visibility that a lot of these people have. I'm particularly also interested by the commentaries of financials. Whether it is NBFC, non-lending financials, or even banks for that matter. The commentary around June, July, and early part of August has been reasonably okay, thanks to the fact that COVID cases have come off, and now we are talking about reopening and vaccinations picking up pace, because that is one part of the market which is not participating, whether it is large cap financials or the mid cap financial. And that is where we have maximum conviction. In fact, in our model portfolio, you will find 350 bips overweight on IT and 300 bips overweight on financials. Aside of that, consumer mid caps, their commentary has been good, but clearly valuations there are still overheated, and they can have some more time correction. If you look at the numbers of Pidilite, numbers of Astral, numbers of Imami, they're not giving you any concern at the moment. It looks like things will improve. And with rural also now sort of making a comeback after this monsoon, you will see a lot of rural-oriented companies and sectors giving you positive bites. Just a last point, if you see the corporate commentary in this quarter, you will have to divide it pre-15th of May and post-15th of May. Pre-15th of May, there was panic all around, and it was quite reflected in the management commentaries, where people were talking about from Feb to May, we are down this much in our demand, right? Because Feb was the peak of just before the second wave began. And post 15th May, the commentary shifted again, that from the bottom of April and May, now we are up this much, this much, this much. And that is continuing at least till now. So unless you see a very unforeseen event again on third wave, which is unforecastable, I think FY22 earnings look quite strong. There has not been any dent in our earnings estimate in 1Q FY22. And this is on the back of a best earnings growth that you have seen in FY21. So earnings picture is looking good.
Okay. Thanks for that, Gautam. Ajay, same question to you. If one is broadly looking at the broader end of the spectrum, do you find favor firstly, and if so, where? I think your answers, gentlemen, really would help a bunch of people who are watching it right now and watch it over the course of the next 24 to 48 hours.
See, Neeraj, one of our biggest committed sectors at this point of time is hospitals in the mid-cap space. And luckily, there are not many options. There are just 2 or 3 companies that you can buy into, so investor doesn't have to do too much research. Because healthcare, we believe, will become the biggest beneficiary of what transpired now. There'll be privatization, there'll be investment, and the growth has been pretty good at this point of time. So hospitals remain one of our biggest committed sectors at this point of time. The number 2 is specialty pharma, not chemical company, remains one of the key things. And these are all companies with fill-finish facilities in India. So those are the kind of companies, and to give an example, not recommending them, example like a Gland or a Laurus, etc., they have done tremendously. And again, they are the ones who are expanding capacity. So specialty pharma companies which have got strong fill finish for, and including the vaccine capability, remain a strong second biggest committed pick at this point of time. The third is that liquor industry, we have reinvested back in liquor a big time, because I think what's happening in Delhi, the revolution happening in Delhi in terms of delicensing and consumption growth story is going to pan out in the rest of the country as government need resources. The third committed story, I think, is going to be the liquor, which is going to see tremendous amount of relaxation, which will come through. The last part of the story that we are committing is export-driven companies. And that's one of the first time we invested, is done well, is textile sector. Exports out of India for textiles have facing one of the best markets in history ever. And I think those companies are undervalued. The returns will come through. We continue our investment in sugar industry at this point of time because ethanol remains the big story, and no new player can come in, really speaking. It's not easy for a new player to come into sugar industry. So I think these 5 sectors remain our true focus on the mid-cap space at this point of time. And strangely, and this is the beauty of the market, 2 opinions differ. We continue to be zero on financial in this country. Absolutely zero. It's historically never happened that I own nothing in financial sector. Maybe a little bit of one gold company, that's all about it, gold loan company. Because we believe that the metrics are showing us that the competition in that sector is going to intensify to the point where I think my colleague just mentioned, on deleveraging on one side, people paying up the loan, no one wants a loan. You can't run the story on repo rates and trading income at this point of time. And the banks are just that story right now. So there is a fundamental problem in that industry in terms of pure demand for the basic product called loans. You can keep giving it to individuals who can't repay back to you. All right. So that's fine. That's okay. And we believe that nationalized banks are sitting on another pool of explosive bad debt. You may not recognize it, but look at the portfolio, 30% Mudra loan, 30% SSI and farmer loan. No government will ever let the banks enforce anything in 2 years before the election in this country. So national banks rule them out. Private banks can keep chasing up. There, I think, roughly 200 fintechs now chasing the customers today in this country. So strangely, financial is not in our portfolio at all. Zero, in fact. That's the biggest call we've taken, and it's done well so far in the last 6 months. Maybe it turns around, as my colleague said. If it goes up, investors will blame me for that. But I think financial we can keep out of it, given there's so many good, better choices outside the system.
Well, no, but as both of you said, the beauty of the market, that there is always a consensus and there is always an anti-consensus, and at times both work like a charm. So always welcome. Yeah, but gentlemen, thank you so much. Really appreciate both of you taking up this time and talking to us. Really appreciate your time. Viewers, thanks for tuning in.